is Sam Bankman-Fried, and I'm going to give a demo of FTX. FTX is a cryptocurrency derivatives exchange that has recently been developed and deployed by Alameda Research. Let's start with the live deployed version here. One thing that sets this exchange apart from the current competitors in the derivative space is the type of collateral that it has. So we can go to the wallet page here. And unlike current futures exchanges where in order to trade Bitcoin futures, you have to deposit Bitcoin as collateral, and in order to trade ETH futures, you need to deposit ETH. For FTX, you just deposit stablecoins. So you can deposit Trust token or you can deposit USD coin here. Depositing either will credit you with a USD balance on the exchange. And you can also withdraw your USD balance in either of these two stablecoins. This is used as collateral for all trades on the exchange. So whether you're trading Bitcoin Perpetual futures or ETH quarterly futures, you use the same pool of collateral and the same coins as collateral, significantly simplifying the process. Another feature that this exchange has that many don't are ETFs. So if you go here, you can see the leveraged ETFs that FTX offers. These are ERC20 tokens that you can create and redeem by clicking on these buttons here. And creating one of these tokens gives you the price exposure of a 3x levered Bitcoin position. But unlike margin positions, it can be freely moved around the blockchain and transferred to, for instance, other exchanges. And the ETF will manage the margin and liquidation risk for you. So you can both get positive exposure, levered exposure to Bitcoin and Ether through these. You can also get negative exposure if, for instance, you created the 3x short Ether ETF. Doing this gives you an ERC20 token whose price action is -3 times the price action of Ether. Let's move on now to the actual futures themselves. So you can look at the March expiring Bitcoin futures, for instance. And as you would expect, there is an order book, a way to place orders. You can see information about the underlying index, the mark price of the futures, and the open interest on this page. One thing that's unique about this, as compared to our competitors, is the structure that we use to handle liquidations. Liquidations are a pretty large problem in cryptocurrency margin trading and futures in particular. The problem that you run into is that if some account has a large position on, and markets move against them so that their account is in danger of going bankrupt, the exchange somehow needs to liquidate their entire position before that account goes bankrupt. If you fail to do this, then the account will go bankrupt and beyond bankrupt, and there will be just a net loss of value on the site that someone has to bear. This gives rise to the clawbacks or auto deleveraging that are common amongst many current cryptocurrency derivatives exchanges. We have a 3-tiered system to attempt to avoid clawbacks. To demonstrate this, I'm going to show the beta version of this. And one thing that's going to allow me to do here is show what happens if prices move. So here you can see our risk backend for the beta version. This is the same system that the live version has, but obviously I can't change the real Bitcoin price. So instead I will alter this one here. So over here you can see the positions that the bots trading on this exchange have. And you can see that there are a number of them that have, between $5 and $20 million of exposure each to these futures positions. You can see that in this column here. And in this column, you can see the total amount of collateral that they've posted. So you can see StaticBot91, for instance, has posted about $3 million of collateral and used that to put on $18 million of positions, making them about 6x leveraged. Over here, you can see that if markets move 6.8% against StaticBot's positions, which in this case would mean, for instance, Bitcoin decreasing in price, StaticBot91 is going to begin to get liquidated. So I'm going to simulate what happens if there are liquidations and explain the various mechanisms that we have to stop clawbacks from occurring. And they're all going to center around finding ways to get these accounts out of their positions before they go bankrupt, so before this total account value goes negative. So to show what happens here, I'm going to start to decrease the Bitcoin price that the simulation is using. So if we go over here, this price here, this button here, every time I click this, is going to decrease the Bitcoin price in the simulation by 1%. So I'm going to click this a couple times here. And what you'll see here is that the price of these futures are starting to move. So you can see this little blue line here is starting to decrease. Maybe I'll click this one more time, and we can check back in on these bought positions. And now you can see that a number of these accounts are actually quite close to liquidation. So StaticBot52, who has $5 million of positions on, is now 2.5% away from getting liquidated. And if we check, we can see that, in fact, they were long Bitcoins. And so it makes sense that as we decrease the Bitcoin price, their account starts to get in greater danger. So far, we haven't moved the price enough for any of these accounts to actually get liquidated, though. So let's start to decrease it more here. So I'm going to go back to this page here, and let's decrease this index price by another few percent. So here you can see this blue line is really starting to drop. This is the index price of Bitcoin here. And click this one more time. And now let's check back in on these accounts. So now you can see this bot, which was a few percent away, is now only 0.5% away from getting liquidated. So let's just move markets a little bit more against it here. And check back on it now. And now you can see some of these bots are starting to get liquidated. This negative number means that they're past the point of liquidation. Now, none of these actually have negative account values yet, which means that none of them have gone bankrupt. But some of these are, in fact, in the middle of being liquidated. And you can see here a list of the orders being sent. So this is our liquidation engine, just sending orders on the exchange to close down the positions of the bots that are getting in danger. And you see most of these are selling Bitcoin orders for accounts that had long Bitcoin positions that are now in danger of going under because we decreased the Bitcoin price. Instead of sending gigantic orders as soon as these accounts get within the liquidation zone, we rate limit how quickly we actually close these accounts down. The reason for this is that if you close them down too quickly, you can cause a sort of death spiral of liquidity where your entire exchange crashes, because more and more accounts are dragging the price down more and more with their liquidations and creating even more demand to sell. So instead, we rate limit how quickly all of our accounts put together can sell at a reasonable fraction of the global Bitcoin volume. And you can see that through that liquidation event, we successfully liquidated all of these accounts without any of them going negative. As Bitcoin goes down more, there's more accounts that need to get liquidated, and so orders are being sent on these accounts' behalf. So far, this is a similar practice in many ways to what current derivatives exchanges do, except that it's a lot more careful about the manner in which it liquidates these accounts in the market so as to not cause a market crash. At some point, though, just being careful isn't enough, because at some point, you have so much demand to sell from liquidating that if you don't sell quickly, the accounts will go bankrupt. And this is where many exchanges get themselves into trouble. If you have a large position on, you can look at this account here, for instance, and drive markets down 5.5%, this bot is nearly bankrupt. And you only have 0.5% room left before it needs to actually close down. But the problem is that if you do that very quickly, if you just try and close it down in the market, you'll drive markets down actually more than the amount of room you had, and it will go bankrupt. Whereas if you go slowly, you run the risk of markets just drifting down while you're slowly working out the position, and it goes bankrupt before it's actually finished anyway. So this is a central conundrum that a lot of these exchanges have faced, and this is what's led to clawbacks. What we do in this case is we employ the backstop liquidity provider program. So all of these liquidations that you see here are standard liquidations in the market, where our liquidation engine just sends orders on behalf of these accounts to close down their positions. If the accounts get very close to liquidation, though, so not just within this zone where we're working out of them in the market, but actually about to be fully bankrupt, the backstop liquidity providers jump in. So you can see here, we are a backstop liquidity provider on this exchange. And what that means is that if there's an account which is about to go bankrupt, and our liquidation engine will not have time to finish closing it down in the market before it does go bankrupt, we will jump in and take over that position. So you can see that we've already done this for a small position recently. And we can show you what happens if we move markets down a lot here. So right now, the system has successfully closed down all of the liquidating positions. Nothing is getting liquidated anymore. So let's move Bitcoin down a lot more here. So note, we've already moved Bitcoin down something like 5%. But let's simulate what happens if it moves down 8 or 10%. So I'm just going to click this button a few more times here. And this is going to drive some accounts very close to going bankrupt. So let's check back in our account status here. And you see that many accounts are very much getting liquidated. Some of them have sizable positions on. And some of these are going negative in value or threatening to do so. And so what happens there is we have just internalized $5 million worth of liquidating positions. These were accounts that were about to go bankrupt, but rather than let them go bankrupt and cause clawbacks, as a liquidity provider for this exchange, we just took those accounts' positions on for them and worked out of the deltas on other venues. What that allows us to do is limit the amount of loss that we see in scenarios where there are large moves. Because when the exchange itself, even if it doesn't have enough liquidity on the order books to support the liquidations that are necessary, we will jump in and provide more automatically. So even though we just gapped Bitcoin down another 4% after it had just dropped 5%, causing a very large movement, and had a lot of accounts getting liquidated here, you can look at the total loss from these accounts, and it's basically negligible. So you can look here at the insurance fund that we have. And through this event, almost $1 million was added to the insurance fund from accounts that got liquidated. And we only had to dip in to use 150,000 of that for the most desperate accounts. This means that there are no clawbacks on the system. The insurance fund successfully covered all of the losses. And in fact, there weren't very many losses to begin with, because as a backstop liquidity provider, we jumped in to take on these in danger accounts. That's the core liquidation risk management system that we use. And that's how we prevent clawbacks even during large market moves, even if there are large positions open. First, we work out of the positions in the market in a calm, collected manner. And second, if the liquidation engine is not going to succeed in closing them down before the accounts go bankrupt, we as a backstop liquidity provider will internalize the positions to prevent socialized losses. This creates calm, orderly markets even during large market moves, and means that users whose positions were not getting liquidated do not face the same risk of having a socialized loss or clawback or auto deleveraging event that you see on other platforms. That's the core mechanism that this exchange relies on to prevent liquidations. And the live exchange here uses exactly the same method. I obviously can't show it because I can't move real Bitcoin markets like that. But that will prevent clawbacks on our live product as well. That's a general tour of the FTX derivatives exchange, the liquidation mechanisms that we have, the stablecoin-based collateral system, and the ETFs. Thanks for watching.